Well, hello traders out there in YouTube land, and welcome to another episode of my weekly portfolio performance update. Well, it's week 13, which is March 24th through the 28th, and we're basically already through the first quarter of the year, and it's certainly been an interesting quarter. But anyway, if this is your first time here on my channel, my name is Andrew, and I trade options. I trade options consistently generating about $5,000 a month through my options trading. And this channel is where I pull back the curtain to show you exactly what I do and exactly how I do it. I post these videos each week, typically on Mondays, to analyze my previous week. All of the trades that I closed out during the week, I analyze through these videos. And I also post videos about general knowledge with regards to options trading and some videos with step-by-step guides on how to trade options. So if you are interested in options trading and you're interested in following me on my journey, my trading journey, be sure to like, subscribe, and hit that bell notification. Before we get started, a quick disclaimer that I am not a financial advisor. Please consult a qualified financial advisor before making any investment decisions. So now, why am I doing this? Well, there's a couple of reasons. First, if you're new to options trading and want to know if it's legit, I'm giving you that ability to see real results from a real trader. I know that there are a lot of these fake gurus out there talking about how successful they are with their trading. Some of it is just stocks and trading stocks and futures, or maybe those kinds of things, or there's a lot of crypto. That's basically the buzzword is crypto trading. But that's not my intention. I want to provide a transparent platform to show you real results from a real person, and that's what I want to do. I'm not here to boast. I'm not here to brag. I'm here to show you that this is possible, and this is what I do. And if it's something that you're interested in, then join me. Join this group. Join this community. See what you can learn from me. And I'm not perfect. There are mistakes. You're going to see that I make mistakes. And when I make mistakes, I'm going to point them out to you. I'm going to try to learn from these mistakes. And hopefully from my learning process, you can learn as well. And my second goal is to build a community around options trading. There's a lot of interest out there in options trading. I have been studying the financial markets for a long time, trying to figure out, I've been fascinated with it. Are people really making money through the financials, like buying and selling stocks or whatever? And it was eventually probably about 2011 where I really started getting into options trading and really started understanding the fundamentals behind them and realizing that, yes, this is a viable strategy for making money over the long haul. And there's a lot of people who have that same interest, that shared interest. And so I want to build that community of folks like that. Whether you're brand new to options trading or if you're an expert and you've been doing it for years and decades, I would love for you to join this community and participate in the communication. Put some comments down below. If you are trading, what's your favorite strategy? What kind of lessons learned have you had? And if you're brand new, what kind of questions do you have? Drop those in the comment section below and join the community. Now, with that said, if you are new to options trading, I do have a video on the channel that I encourage you to watch. It's called Demystifying Options, and it covers some of the basic concepts around options trading. I highly encourage that you watch that before watching these videos. It will help you to understand some of these concepts that I talk about in these videos. I do have it linked in the description below. All right, so now what to expect from these videos? First of all, what I'm going to do is talk about the strategies that I employed during the last week. I'll talk about the goal for those strategies. I'll also show you each one of the transactions that I did using those strategies. and what my profit and or loss was for each one of those trades. And then I'll do basically kind of like a performance analysis of some of my most notable trades. And then from there, I'll do an overall performance for the week. How did I do for the week? What was my total? Did I make money? Did I lose money? And how did it compare to other weeks previously throughout the year? And then finally, if I have any insights about those trades that I did for the week, I will share those insights with you. And again, building a community of discussion and learning together. So now, before we get into week 13's transactions, let's take a look at all of the transactions for the previous weeks up until this point. As you can see, my total for the year, I've generated $59,329 in profits through my options trading, which equals out to be $4,944 per week on average. If you've been watching the financial markets here recently, you know that it's been a very challenging market. So for me to be able to post these profits consistently, obviously you can see they've not all been profits. I've lost money in week 9, I lost money in week 3, but every other week I have made money. So for me to be able to do that when I know that there are a lot of other traders that are losing money, I think that's pretty notable. But so, how did I do in week 13? Was week 13 an unlucky week for me? Well, just stick around, find out, we'll see. So in week 13, I closed out a total of 22 trades, and in order to go through those trades, I want to switch over to my trade tracking platform. And this is where I kind of go on my little rant about it. If you're new to options trading and you're wanting to get started, I highly recommend that you track your trades. That's one of the mistakes that I made when I first started out trading options, is that I didn't track my trades like I should have. And the thing about options trading is that one of the risk mitigation strategies that we use for options trading is to trade small and trade often. Meaning that we, instead of trying to hit a grand slam home run with our trades, we don't do that. We should never do that. It can be tough because when we have a long string of successful trades, it can kind of lure you into, hey, I can make more money by putting on bigger and bigger trades. But as soon as you start to do that, as soon as you try to hit that grand slam home run, you're going to have that big losing trade, and that can just totally blow up your account. So we trade small and we trade option. And we do that because the more occurrences we have, the more we can align ourselves with the statistical probabilities. And every time we put on our trade, we can see what the probability is of being successful. And of course, we're always going to give ourselves an 80, 70, 80, 90% chance of being successful. But at the same time, when there is an 80% chance of being successful, which sounds great, there's also a 20% chance of being unsuccessful. And if that big loser comes when that 20% rolls around, it can be devastating. That's why we trade small and we trade often. So with that said, you're going to be putting on a lot of trades. And if you don't track these trades, and that is time consuming to use whatever means of tracking your trades is, whether it's spreadsheets or some kind of online commercial platform, it does take time to record these trades. It does take time to do it, and that's why a lot of people tend not to do it, because they just want to make the profits. They don't want to be an accountant and track all of these trades. They just want to collect their money. But let me tell you, from experience, you got to do it. You got to track your trades. Over the years, I've been searching for the best system to track my trades. I've gone from complex, complicated spreadsheets that track all of the data to more simple spreadsheets that only track maybe just the most important stuff. I've researched online commercial platforms, and I don't know why, but it's very difficult to find a good platform that can smoothly, efficiently track your trades for you. But I've got good news. I think I've found one that beats all others. Actually, I'm quite confident that I have. The system that I'm currently using is TradeZella, which is good. It's fine. I was excited about it in the beginning, but as I've used it more and more, I'm finding little issues and little problems, and I'll cover some of those in today's video. that made me decide to look for something else. And I'm glad that I did, because I found something that's far superior. It takes care of all the issues that I'm having with TradeZella and provides some benefits on top of that. So, however, I'm not quite done with the transitioning from one platform to the other yet, so I'm not ready to display that yet. I'm not ready to use that to display my trades, but next week I'll definitely be ready for that. And I'll be excited to use that to show you my trades next time I do my update. But for today, I'm going to hop on over to my TradeZella platform so that we can go through last week's trades. All right, so here we are in the TradeZella platform. You can say goodbye to it. This is the last time you're going to see it, because next week, as I said, I will be switching over to my new platform. But I'm going to start off this week with my bread and butter strategy, which is the weekly wheel. If you've watched any of my previous videos, you've heard that term, that strategy over and over again. It is my most frequently traded strategy. And here you can see that I did 16 weekly wheel trades this week for a total profit of $3,533. And if you want more information, if you want a step-by-step guide of how to trade this strategy, I do have a video on my channel called How to Print Money Using the Weekly Wheel or the Wheel of Fortune, and I do have that linked in the description below. So I definitely encourage you to go check that out. But let's take a look at a couple of examples of the trades that I did for this week. So the first one that I want to show you is one I did in Palantir. And this is where I sold a put that ended up going in the money, so I got assigned the stock, and I want to show you what that looks like. All right, I've got the stock chart pulled up, and if we take a look here, you can see that I sold a put that had a 94 strike price. I sold that put back on March 24th. I sold 6 contracts and collected $1.80 per contract. And the stock at that time, or the option, was out of the money. So the stock was above the strike price. And it stayed there for, what was that, maybe a day or two. And then the option ended up going in the money because the stock dropped below the strike price of the put. And as you can see, it remained below the strike price of the put until expiration, which is represented by that hourglass. And so what happens when a put that you sell goes in the money? Well, you have to buy the stock at the strike price of the put. So I have to buy 600 shares of Palantir at $94 per share. And so what will happen next week is that I will start selling calls against those 600 shares of Palantir that I own. And actually, I've already started doing that. So what I do, if Friday rolls around and my put is in the money and it looks like there's just no way it's going to come back out of the money, I'll go ahead and preemptively sell my calls so that I can start seeing that theta decay or start benefiting from that theta decay right away. So that's what I did. On Friday, I don't know, I think it was about midday, I went ahead and sold a call. I sold 6 calls on Palantir since I own these 600 shares. I sold those 6 calls against these 600 shares to jumpstart that process. All right, so that's Palantir. Let's take a look at another example. And this time I want to show you an example of a weekly wheel where I sold a call against the shares that I owned. And I know that happens to be the case here because this says C1. It was tagged with a C1 tag, which means this is a level 1 call that I sold. And when I'm selling calls on the weekly wheel, it means that I've already been assigned the shares after selling puts. And that's the case here with Google. So let's take a quick look at it. All right, so I got the stock chart adjusted here so that you can see what's going on. The blue line at the top, those are the shares that I own. And as you can see, the blue line is indicated $187.50. That means that I bought the shares at $187.50 per share. However, if I scroll over a little bit here at the end of that line, which the arrow represents that it's ongoing, it's pointing to the right, meaning that we don't know when this is going to close. So it's an arrow pointing to an indefinite time frame. But the CB means cost basis. And so my cost basis on these shares that I own, the shares that I bought at 187.50, my cost basis is 170.16. How did it get to 170.16? Well, I went through a process of selling puts, collected premium, which drove down my cost basis, and then after I was assigned the shares at $187.50, I started selling calls against those shares, further driving down my cost basis, and what it is currently right now is $170.16. Why is it important for me to track that cost basis? The reason is because I cannot sell a call that is below my cost basis. And the reason I can't do that is because you never know when the stock is going to shoot back up, causing the call to go in the money. And again, if the option is in the money at expiration, you have to sell the shares at the strike price of the option. So if my option is below my cost basis, in that situation, I would be locking myself into a loss. The number one priority with this strategy is to conserve capital. The reason why we want to conserve capital is because the capital is what allows us to make the profits. If we don't have capital, we can't make the profits. So we have to first and foremost protect the capital. And then the next priority after that is to collect the income off of that capital. So at the end of the day, I'm willing to take a reduction in the income that I generate from this capital in order to avoid losing capital. So as we can see, on March 26th, I sold 6 calls for $1.24 per contract. And then on March 27th, 2 days later, I bought them back for 62 cents, making $364.39 on those calls. All right, now going back to all of my weekly wheel trades, again, it was 16 trades for over $3,500. And as you can see here, there are 3 different stocks that I trade this weekly wheel strategy on. It's Google, Palantir, and Amazon. And if you watched my video on how to print money using the weekly wheel, one of the things that I cover in that video is to only do this strategy on stocks that you don't mind owning. And those are 3 stocks that I don't mind owning. They have great business models, they have great financials, and I don't believe that they're going anywhere anytime soon. Probably the riskiest one of the 3 is Palantir, just because it is a newer company compared to Google and Amazon. But I have pretty strong convictions in all 3 of them, and because of that, I don't mind owning stock in any of them. So now let's go ahead and take a look at how much money I made on each one of those. And to do that, I can just come up to my filter here. And this is one of the things that I don't really care for this platform. It just requires a lot of clicking around, and it requires more thought to figure out how to get the data that you want to get. But in order for me to look at each stock individually and how I did for each stock, I just come up here and click symbol, and then I can type in the symbol that I want to see. So let's start with Google. I'll apply the filter. And for the weekly wheel on Google, I had 7 trades for just under $1,000, 973. Come up here again, close out Google. We'll take a look at Amazon and apply the filter, and we see that we had 6 trades for Amazon with the weekly wheel for a total of $1,365. And then the final is Palantir, PLTR. Oops. Apply that filter, and we can see I had 3 trades for a total of just under $1,200. So the weekly wheel has been treating me very well, and we'll certainly continue to trade that going into the future. Now the next strategy I want to talk about is the poor man's covered call. So let's go ahead and pull that up. I'll go up to my filters here, go to the playbook, close weekly wheel, and put in the poor man's covered call, filter that out. And here we can see a total of 5 trades. And here's another reason why I don't care for this platform. As you can see from the profit graph, it shows a negative zone where it shows that I had some losses there. But if you look at all of the trades that make up this graph, you don't see any losses. So why is this showing a loss? Well, I know the reason why. And the reason why is because one of these trades, I actually rolled the position. And so when you roll, that's kind of a controversial. There's a lot of debate in the options trading community about whether or not an option strategy that was rolled for an eventual profit was really profitable. Because the reality is when you roll an option, at the time that you roll it, you are taking a loss. You are closing out that transaction for a loss and then opening a new transaction. But if you are eventually able to collect a profit on that trade, then I believe it is a viable strategy to have a profit overall. And that's what I want to show in my trading platform, because the way I see it is knowing how to do these rolls is part of the knowledge and part of the skill of a trader. Now, if you know enough about options trading, you know that the ultimate goal is to get in and out as quickly as possible. I mean, it's really kind of common sense. It's no different than if you were a car dealer and maybe you owned a used car lot and you bought these cars maybe from auctions or maybe from people trading them in. You have to use your best judgment and your knowledge about cars to be able to buy the right cars at the right price to where you can turn them over quickly. Nobody in the auto industry wants to buy a car to have it sit on their lot for 6 months to a year. They want that thing gone within 30 days, probably within a couple of weeks. So they have to make sure they pay the right price. They have to make sure they buy the right cars. And the same thing with options. When we open an options position, we are putting up a certain amount of capital to have that option position open. We want to get that capital back as quickly as possible and hopefully with a return on that capital. But sometimes it doesn't go as planned, and sometimes those trades can get extended for a period of time. But at the same time, if you're a car dealer, would you prefer to sell a car at a loss, or would you prefer to hold it for another month or two so that you can get a profit out of it? I would say that most dealers probably would be willing to hold it if it meant they could make a profit off of it. And the same holds true with options. So we want to be in and out as quickly as possible, but the rolling strategy can help us earn a profit by extending the duration. Of course, there's a trade-off with that. You have to wait longer to get the profit, but for those of us who would rather have the profit and show a profit, we're willing to do that. So the way this shows that there's like a loss here or a negative, I just don't care for it. I don't like that. That's not how I want my platform representing my trades. If I have the knowledge and skill to kind of combine these trades together in order to show an overall profit, I want my platform to show that and to illustrate that and to represent that. Okay, enough of that. So let's go ahead and get into the poor man's covered call. I do want to show you an example of how this works. And what better example to show you than the one that I rolled, which is this one right here. So let me go ahead and get that open and I'll get the chart set up. All right, I've got the chart set up here and let me just explain what's going on with the poor man's covered call. And this is one of my upcoming videos. I think it's going to be my next videos to describe step by step how these trades work in more detail than what I do in my weekly videos and give you a step-by-step guide of how to set them up for yourself. But essentially what's going on is the purple line is a call option that I own. So it's a strategy that's called a leap, which is a long-term option that even though we don't normally buy options, we're okay with buying longer-term options because the effects of time decay are less damaging when you go that far out in time. And it leverages your buying power. When you buy stock, you have to pay whatever the share price of the stock is. But when you're buying calls, all you have to do is pay the price of the call, which is typically much lower than the price of the stock, and you're controlling 100 shares with those calls. So what I did here back in, I think this was August of last year, is I bought this call, which was an 82.50 strike price call on NVIDIA, and I'm just holding on to it. But during this time frame that I'm holding on to it, and especially in this case where I'm showing a profit, I mean, if I were to exercise my call, I could force the call seller to sell me the shares of NVIDIA at $82.50 when it's currently trading for $109. So obviously I have an immediate profit there. And so why not sell calls against these calls that I own? And that's what I did here. The yellow line is where I sold a 114 call. I sold this back on March 10th. And then you see here, now let me just step back here. When I sell these calls, I am staying pretty far away from the current strike price. And the reason for that is because I don't necessarily want to lose my leap. I mean, if push comes to shove, yeah, I'll go ahead and lose my leap rather than losing money, but I do want to hold the leaps for the long term. And the only reason I'm selling this call is to earn a little extra income from the fact that I own these long-term calls. But here's the drawback to it. If the option goes in the money by having the stock price go above the strike price of your call, you could be forced to sell those shares. And in order to sell the shares, you would have to exercise your call here to buy the shares so that you could sell them. And if you don't want to do that, then there is a way you can avoid that. And that's what I did right here. The reason this line is yellow is because even though this option expired here on the 25th, on the day of expiration, so what I did is I bought this call back and I sold this longer term call, which had an expiration out at, what was it, April 17th. And by doing that, I was able to collect extra income and I was able to extend the duration of the trade. So rather than being forced in this position of having to exercise my call, buy the shares, and then turn right around and sell those shares, I just extended the duration of the trade. And it's a good thing that I did, because if you see the stock, it actually did go in the money for this call, but it dropped back below, went back in the money, dropped back below, and I was able to close it out for a profit, and I ended up making $61.44. Not making me rich, but you know, hey, it's profit, and I like collecting money. I'd much rather collect money than give away money. Okay, so those are the poor band covered call trades. I did 2 on Palantir and 3 on NVIDIA for a total profit of about $250. Hey guys, just wanted to give you a quick correction. As I was reviewing the video before posting it, I realized that during this upcoming section, I referred to a call as a put and a put as a call. I just reversed the two for whatever reason, not sure what I was thinking, but whenever I refer to a call, I'm actually talking about a put and vice versa. So apologize for any confusions, but I just wanted to make sure that I cleared that up for everybody. All right, back to the video. All right, so I have one more strategy to cover with you, and that is the strangle that I did last week. So let me go ahead and get that pulled up. We'll go back into the playbook filter here, put in the strangle and filter it out for the strangle, and here it is. It is on the SPY or the ES, which is the futures for the S&P 500. And I was able to close out a strangle for a profit of $2,326. This is one of my favorite trades because, as you can see, it's very profitable. At least it can be if it works out, and it works out in many cases because of how I put this trade on. But let's go ahead and jump into the stock charts so that I can give you a visual representation of how this works. All right, so we have the stock chart set up here so that you can get a big picture view of what's going on. And just so you know, these are longer term trades. I'm not closing these out every week. I'm usually closing these out maybe every 3, 4, or 5 weeks. And so what I do to put on these trades is I sell a put and I sell a call. And as you can see, it's pretty far away from the stock price. And that's why it has such a high win rate. So back on 13 February, I sold a 6,700 strike price put, and then I also sold a 5,275 strike price call. And for that, I was able to collect $26.25 for the put, another $7.25 for the call, and that gave me a total premium received of $33.50. Now that I have this position open, we take a look at how the stock performed, and as you can see, it started trailing off and started falling. And when the position is first opened, these options are pretty evenly spaced so that the stock price is about halfway between. I mean, if I feel like the stock is going to go down, I can skew this up or down to give myself a little bit more leeway in either direction. But as long as the stock price stays within these two contracts by expiration, then I'm going to make the profit that I'm looking for. And for these trades, my profit target is 50% of the credit received. I've already said that I received $33.50 in credit on this trade, so that would make my profit target $16.75. Now again, we move forward in time and we see the stock is selling off and it's moving closer to my call. And that's what we refer to as testing one side or the other. If it's moving down, then it's testing my call. If it's moving up, then it's testing my put. We don't want it to go beyond either one because then that puts us in a losing position. We want this to stay between the two. Now, if it starts getting too close to one side or the other, there is a strategy that we can employ to help increase our chances of success, and that's what we call rolling the trade or rolling one side or the other. And when we do a roll for a strangle, we always roll the untested side. So since the call is the tested side here, we want to roll the put. And as you can see, that's what I did here. You see one yellow line, which was the original put. But here what I do is I buy this put back, and then I sell another put at a lower strike price. So I bought back the 6,700 put, and then I sold the 6,400 put. I bought back the 6,700 put for $1.20, and then I sold the 6,400 put for $8.30. That gave me an additional credit of $7.10, and then we wait to see what happens from there. And as we can see, the stock price continued to decline and continued to test my call. So I decided at this point right here that it was time to do another roll. So I bought back the 6,400 put, and I bought that back for $2.50. And then I sold the 6,150 put, and I sold that for $16. If we get a pop up here, I believe it was. Yeah, we sold that for $16, and that gave me an additional credit of $13.50. But now let me point out that even though we're collecting more credit, my goal is still the same. I still want to collect 50% of the initial credit received. So my profit target is still $16.75. At this point, we collected $50.10 in total premium. So if you take $54.10 and subtract out my profit goal of $16.75, that means I do not want to pay more than $38.34 to close out this position. And as we move forward here, we can see the stock price starts to go back up, then it starts to come back down again. And then I finally, on March 25th, which was Thursday, I think it was, I went ahead and closed out this position, and you can see that I bought it back for a total of $38.75, which gave me a profit of $15.35, which was below my target of $16.75. But at the same time, I was being aware of the market conditions. I was seeing that the market was being volatile. I saw that it was selling off. And sometimes under those conditions, it's best to be more conservative with your profits, which is what I did. And it's a good thing that I did, because if you look at what happened directly after I closed out this trade, it continued to sell off. And what happens is, when the stock sells off, the volatility increases, which increases the price of the option overall. And had I not closed out this position when I did, there's a good chance I could be in it for another week or two. Again, we want to be in and out as quickly as possible. So I think it was a good call to give up a little bit of profit to get out of it sooner and not drag it out for another week or two. All right, so that's my trades for this week. Let's go ahead and go back and look at my totals. Let's go ahead and remove the strangle and look at all of the trades for the week to see what my total is. And here it is, grand total of $6,109.67 in profit off of 22 trades. Now, if we plug that into the table, we see that my profit of $6,110 was actually my 5th best week for the year. There's only been 13 weeks, so I guess that's maybe about average. It's a little bit above average, which if you look at my average for the year, it's $5,034. This is about, let's see, I did the computation. This is about 21% higher than my average, which was pulled up by this number. So it was a good week overall. And especially with what's going on in the market, I know there's a lot of people out there right now who are suffering with what's going on in the market. So for me to be able to continue to post profits week after week, I'm very happy about that. But I must say, looking forward, it is going to be a struggle to be able to continue posting profits at least at the level. I mean, I am expecting that my profits are going to decrease moving forward. Either the market has to settle out at these new lower levels, which even that's going to affect my profits, or I need to start deploying more bearish strategies, or maybe a little bit of a combination of both. But that's just the key to options trading. And that's the key really to any trading, is to recognize what's going on with the market, and instead of trying to fight it, figure out how to adapt to it. And that's what I need to do moving forward. All right, so anyway, that's it. That's a wrap for this week's portfolio performance update. I hope you enjoyed it. If you have any interest in the content that I'm sharing, please like and subscribe to the channel. If you have any comments, any questions, any experiences that you would like to share with the group, please drop those in the comments section below. Thanks again for stopping by. I appreciate you checking it out. And until next time, have a great week. Bye-bye.